Hi, Ellie. Welcome back onto the show.
Hi, Andy. Good to be back as always.
We've had a base rate reduction, and I think I want to start there today. I want to know what you think about this, and I suppose what the markets are thinking about this, and what lenders think about this. We talked in our last sort of catch up together about the likelihood of rates coming down, and it was interesting because I think in our last catch up, things in the UK looked like they were potentially going to be quite stable, and then Trump started all of his sort of noise with the tariffs, and everything started to wobble a little bit.
Yeah.
Things have potentially changed a little bit there, although not completely, but nevertheless, there has been a base rate reduction. So where are we at today? And can you give us your thoughts on that? The split, I think, of votes
that was interesting. Yeah.
And the way that the markets and lenders have reacted.
Yeah. So it was an interesting one because you've got a couple of people wanting to reduce it by 0.5% and then a couple of people wanting to keep it as it was. So it was a very split decision. So it'd be interesting to see what happens like next month off the back of that and whether people change their mind. But just before the meeting, lenders were starting to reduce rates. We saw it as normally the high street lenders that come out first. So the likes of Barclays and Nationwide are normally first. And they were starting to reduce it before Thursday's meeting. And then, we've seen some reductions, not loads and not by a huge amount, but we are starting to see things filter through, which is good news, really good news.
I think it was an interesting split of votes, and I think there was absolutely no doubt about it. The rate was coming down.
Yeah.
It was pinned.
Yeah.
It was pinned on. Everybody knew that.
Definitely.
Markets had priced it in. But I think the fact that there was still a couple of the MPC members that wanted to hold it, I think that has actually had maybe more of an impact, in terms of the outlook and swap rates than perhaps a lot of people have realised, because I think that signal was really, it's sort of saying that maybe rates aren't going to come down as quickly as we hoped and thought.
I think that's exactly it, isn't it? Because you've got this balance between, awful April that we had last month, didn't we? With everything going up, council tax, and there was an array of things, wasn't there, that had gone up in April. And then we are going to see that inflation impact starting from this month's inflation figures. So inflation was at 3% before awful April, so there's a potential for it to go up higher. So that's, I think, a big consideration. The ECB had reduced the base rate a few weeks beforehand. So I think, as you say, it was already priced in with markets. Everyone sort of knew it was coming. But was it more of a, we'll give you 0.5% and you need to be happy with that? Or is it the start of something to cut? I probably am erring on the side of you can have a 0.25% to keep everyone happy. Will it come down further? I don't know. I mean, as you say, things have settled down like more worldwide. We've had Trump agreeing trade agreements, haven't we, with China, with the UK. So things are starting to steady, but they're still a whole lot worse than where we were prior to him bringing all these tariffs in. So although it's good news in terms of settling the market, is it good news in terms of trade? Probably still not.
We'll come on to this. I want to talk to you about the general feeling and sentiment in the market at the minute. Obviously, you're very close to the coalface, and in terms of actually handling a lot of the transactions, and you could have got all of that insight. As an investor, as a landlord, the rental market and stuff that I'm looking at buying, I've got my own thoughts on stuff and what I'm seeing at the minute. But in the context of those rate reductions, I also want to have a chat to you later on today about what things look like out there in the market at the minute and what the rest of the year could potentially look like. But before we get there was a really interesting question asked by one of our members in the community the other day that you weighed in on. And the question, and I thought it was a great question actually, was whether or not to fix or track at the minute. And of course, a while ago, we were all asking that sort of question when rates were high.
Mm-hmm.
Now we're sort of asking it for a different reason. Can you tell us about, I suppose, that thread, kind of the different opinions that people had, what your opinion was and your general advice was? And obviously the caveat being that everybody's circumstances are different.
Of course, And it's always best to speak to your broker. But, I mean, with my regulated mortgage hat on, in a previous life, when I was looking at client circumstances, we weren't really ever thinking about trying to chase rates. That wasn't really the prime driver for whether to decide whether to have a shorter or longer term fix, whether to track. It was more about life circumstances. And obviously with residential mortgages, it's different, how long you're going to stay there, change in income, kids, marriage, all those sorts of things, retirement, all those things that come into play, which it doesn't necessarily with investment. But you've still got things like how long are you looking to keep the property? Are you going to be able to refinance and pull money out in a 2-year period, or do you need to leave it more of a longer period? If you're looking at investment values on HMOs, it's unlikely that you're going to be able to pull that money out again. Could property prices come down? You know, if you're looking to refinance in 2 years' time, could that potentially be a problem? They're all the kind of questions that I would be asking rather than chasing interest rates. I don't think you generally do well chasing interest rates. The other thing is that it's so expensive to remortgage. You know, you're looking at least a 2% arrangement fees. You're looking at legals, broker fees on there. So every time you come to do that, there is a big outlay and time. And the more properties that you have, the more often you're going to be remortgaging and the more time you've got to put into it. So they're all the things to consider before you even start thinking about, am I going to chase a rate? Looking at interest rates, variable rates, I was having a look this morning, are roughly 1.5% to 2% above fixed rates as a very general. Obviously, it depends on what lender. And with trackers, you're normally looking at either no ERC, like lifetime tracker, which is even more expensive, or you tend to be on a 2-year tracker. And still at the end of that 2-year tracker rate, you'll go back onto the lender standard variable, which will be more expensive. So it tends to be a more shorter term option or quite an expensive option. And then you've got to think about, is your rental enough? Is your rental going to cover it? Because you're looking at a stress test of maybe 8-9% rather than 5 or 6. So there's all those things to go into the mix. Really what you've got to think about is, do you genuinely think that the base rate's going to come down by more than that 1 or 2% that you're paying on top of your fixed rate? Because over a period of time, you need to average it out at 2% below where you are now, don't you? So do you think that's going to happen? And then when you factor in your fees of refinancing potentially in 2 years' time, that's something to consider as well. So, I mean, it sounds like I don't think variable rate's a good idea.
Well, it's interesting because there's actually so much to think about and consider if, you know, if you are currently refinancing or buying anything and need a mortgage. I mean, for what it's worth, my thoughts on what I'm doing at the minute is I'm definitely fixing. I suppose in some ways, taking a risk on my cash flow isn't something that I generally like to do.
Absolutely. That's the other thing, because we don't know. And with the people that are in charge around the world at the moment, you know, naming no names, there's a lot of uncertainty that could potentially happen again. And yes, we can say, well, interest rates are generally higher. We'd like to see it, think that it's on a kind of downward trajectory. There's no guarantees with that. So do you want to risk that? And that's really what it comes down to. And that's why most people do fix their mortgages, because even though they may gain from it, the certainty of knowing what their payments are more important than the potential of the gain that you might get in the future.
Definitely. I think predictability is one of the best things about being a landlord, especially in the HMO space. If you've got good tenants who stay and pay, it's a fantastic business model. You've got just that recurring income that's very stable, very predictable, and you can plan off that. If things change and you're subject to interest rate changes because you're on a variable rate, that's not the case. And that could potentially make it more difficult to plan. And certainly it does just add an element of risk that you need to think about. You certainly would have to think more so about having some sort of a cushion in case interest rates for any reason spiked. And that's not something I really like to do. It's not really where I want to be paying my attention. I would much rather be putting my attention and focus onto shaving costs on refurbs and projects, trying to get the best possible value when I'm buying something, taking risks in other areas where actually I feel like I might have a bit more control on methods of mitigating that risks.
Yeah.
So, for example, how and what we develop is a really good example. But for me, I think still at the minute, for the reasons that you mentioned around fees and the actual costs of switching mortgages, and because of the lack of predictability, for me, I'm definitely still fixing. And actually, I think for pretty mainstream stuff at the minute, for example, my buy-to-lets, the rates are not anywhere near as bad as they were. You know, don't get me wrong, it still comes with a bit of a sting and we're still nowhere near where we were. Stress testing on HMOs, as we know, is much easier.
Totally.
And why put yourself into a position where you're having to have those sorts of conversations and maybe not get the loan to values that you want or need because you're just really trying to push it on a rate. It just doesn't make sense to me. So for me, I'm still fixing, and I am hopeful that rates, and I do still think rates will come down this year. I think odds are that they will, perhaps not as quick as we think. I don't think we're going to see anything exceptional in that case, but I do think they'll trickle down.
Yeah.
I'm just fixing him for 5 years at the minute, and I'm going to keep doing that until I see anything that really kind of changes my opinion.
Yeah, I on the whole agree. Obviously, this isn't mortgage advice, but yeah, on the whole, I agree. I think the sort of the 5-year fix really needs to be the default. And then if there's a particular reason why you don't want that, then fair enough, go for something else. But I think that sort of needs to be the point that you're moving from, because you pay a 3% arrangement fee over 5 years, it's 0.6. You pay a 3% arrangement fee over 2 years, you're adding 1.5% to your loan, aren't you? So when you take all those factors into account, you've got to be looking at a base rate that's significantly lower than where we are now to justify those costs and to make that back. And when you think, even when base rate was at 0.1, I think the interest rates, off the top of my head, I can't remember exactly, but were around the 3.5% figure. So with the likes of Fleet and Landbay now, you're looking at just under 5%. So we're not that far off. Even if the base rate comes down by 1%, how much of that is going to be passed on? Probably half of it at most. So, we're not looking at big numbers, are we? It's small.
Let's talk about business volumes then. I think that the market is a peculiar place at the minute in a really strange way. Looking back at the last few years, despite all of the turbulence and problems we've had, it has not been a buyer's market. It's definitely remained a seller's market, but things seem to be a little bit different. And obviously we had a big rush, before the April deadline, didn't we? With stamp duty, peaking sales volumes. But it doesn't feel like that momentum has carried through into May as well. But what are you seeing and feeling, Ellie, on the other side? From what are the lenders experiencing?
Yeah, I think we are definitely seeing a drop. The lenders that I'm talking to, other brokers that I'm speaking to, the business volumes have definitely dropped. And it's been like a slow decline, I would say, with new inquiries. We have had such a busy few months with completions, but that's things that have obviously been in the system for 2 or 3 months now. New inquiries wise, May has been quieter. It's a difficult one because Easter always tends to be quiet. Me and Jackie always joke, because I have this panic every Easter that, where's all the inquiries gone? And she's like, it happens every year. Everyone takes holiday. You can have a few days off and get 2 weeks off, can't you? As kids are all off and everything. Lots of bank holidays, sun shining. I think that does mean that people take a little bit of a break. And particularly where, like you say, we've had the stamp duty deadline, it was so busy in the run up to that, sort of from November to February, it was chaos. And you can't really continue, like as a brokerage, we cannot continue on those business volumes like constantly. We'd all be burnt out. So we do need to have a bit of a break. I am seeing lenders are starting to do things like free legals. We've got a few cashback options. Shawbrook have got a special edition rate that we're able to access as strategic partners, which has got a minimum loan of 250, and I've actually got a few through at like 225, 230. So they're obviously trying to get that business through. They want those extra deals. So yeah, it's definitely quietened down. So is that more of a buyer's market? I suppose people still need to sell, It may not be an ideal time, but there's still plenty of people out there that need to buy. And I suppose the types of clients that we get where, you're looking to buy property to do works to it, they tend to be a need to sell rather than a want to sell scenario. Yeah. So yeah, you're still going to need those things. I suppose it's trying to find that price point, and maybe that's the thing that's slowing things down a bit of market readjustment after the stamp duty change.
I've definitely found that the market has softened a little bit from a rental perspective.
Yeah,
the rents
that as well. Yeah,
the rents that were climbing, that sort of double digits, and that's definitely slowed. I would say that rents at the minute are pretty flat. Certainly most of my stuff, we're not putting it up anymore. We're holding it. We're not reducing it, but I would say that that's definitely what we're experiencing. Volume of inquiries is just down.
Why do you think that is then, from a rental point of view?
I think that the cost of living issues that we've been talking about for a long time, off the back of inflation, I think we're now seeing that it's actually impacting people on in terms of what they can actually do on a day-to-day basis. And that forces people to reassess their decisions. What's more important? Is it, paying an extra £100 or £200 on their rent, or actually is that something that they're prepared to compromise on? Will they compromise on perhaps living in a different location, live in something that's of a similar spec, but maybe the location isn't quite as good? So I think those sorts of things are definitely creeping through. I think also as homeowners, as households, I think as sort of wage increases has kind of slowed and the kind of the heat's come out of that, all you need to do is go down to the supermarket and you just look across the shelf, and that impact of inflation is now so apparent. Yeah, you can't walk out of the supermarket without really spending £100 these days, and you haven't got a week's worth of shopping for that at all. So I think there's a combination of all of that stuff, plus then the additional tax disadvantages that were brought in earlier this year, and a little bit of uncertainty just sort of in the wider sort of global and economic space. I think there's a
Do you think
lot of
people just
headlines.
aren't moving then, or they're finding cheaper places to move to?
I think some people are just not moving, and they're probably prioritizing home improvements over moving, or maybe not doing anything. I think that some people are still moving and some people still need to move, but they are more budget conscious and they are compromising more on things that a year or two ago they may not have felt like they needed to. People, I think, and our tenants are genuinely not able to afford some of the niceties in life that they were able to afford a couple of years ago. And it just forces people to rethink. Same for homeowners, same for households. So I think there's a lot behind this, but I think that it is all sort of steering towards a bit of a slowdown in the market. Don't get me wrong, I'm not suggesting at all that the market is significantly dropping or crashing. I just think that the growth that we've been experiencing is definitely slowed. And I think that it is turning into a bit more of a tenant's market and a bit more of a buyer's market. Great, if you're a buyer and you're in the market to buy something at the minute, it's looking better now to buy something that it has done for a few years. Not great if you're a seller. I'm both.
But I think that always takes a time to adjust. I remember when we had the last stamp duty changes, when we had the stamp duty holiday in COVID, then when that stopped, it all slowed down because for a period of time, you've got buyers saying, well, I've got X amount extra to pay in stamp duty on this property. And you've got the seller expecting to still get the price that they would have done with the previous stamp duty rules. And there is always going to be a bit of a movement in there, isn't there? And I think sometimes every time there's a change, there's a bit of time then for people to catch up with where they need to be and make those adjustments. So
it's mid-May, early to mid-May. The next Bank of England meeting is on the 19th of June. We're at 4.25% today. Would you like to hazard a guess? Stick your neck out, Ellie. Where do you think we'll be in June?
I think I'm sort of torn between stay the same and maybe a 0.25 reduction. And I think that will depend on what the inflation figures come out as. I think this will be the end of the month, won't it? It's only the last week of the month. So I think if inflation stays the same or drops, but I don't know how that would do, I think we'll probably see another reduction. But I think if there's any increase above 3% on inflation, I think we'll have to stay the same. I can't see how they could bring it down.
Yeah, I'm going to say 0.25% drop. I think we're going to be at 4% in June, and I'm still on for 3.5% by the end of the year.
When I spoke to the Bank of England, which was 2 years ago, I think, before all of the chaos that we've seen in the last 2 years, and they said that by the end of 2025, we'd be down to between 3 and 3.75. So we're not actually that far off, are we? And the sort of the downward trajectory is there potentially, but I think it's going to really depend on inflation figures. It's going to depend on what happens with these trading deals. There's so many things that are going into the mix. It's so hard. I would love to see a reduction, and I think that's probably what the market needs to pick it up. Otherwise, I think we are going to have a much slower year than last year. But then we're just doing our end of year accounts, and we've had a 20% increase in our turnover this year than last year. So that's a huge increase in numbers. I think some of that has been driven by more expensive property prices. That may have an impact, but I think a lot of that is far more deals that we've got coming in. But again, can you sustain that long term? Can the market sustain that long term? I think this year will be slower than last year.
Yeah, I think underlying the impact of interest rates is the very fact that it simply just costs businesses more to operate and produce the same goods or services.
Yeah.
And that, when interest rates are high, that makes it difficult for them, and that slows the economy. That that reduces growth in GDP, and
it does.
I think the government know that they need to help businesses at the minute. It is quite difficult as a business owner, generally speaking, at the minute. The new tax changes really haven't helped, but I think we are seriously close to making it, very, very difficult and really kind of slowing the economy too much. So I think there will be a strong incentive to make sure that doesn't happen.
Yeah.
I think we've absolutely got to hope that none of the world's leaders press the red button. We still don't quite know. I said last time we caught up that other than the tariff troubles, that things were looking quite stable and predictable. I would say that they're looking more stable and predictable today than they were then, which is good news overall. I would say I'm feeling a bit more positive than I was last time.
I agree. And I think as much as we can say that, Trump is causing some sort of chaos and what have you, they've got the same problems in America as we have worldwide, with the cost of living and inflation going up. And you've got to get to a point where you've got to get GDP up, because unless you're growing as an economy, then you've got a problem, haven't you? There's loads of other things that will cause a fallout from that. So that is key. And I know that we've had issues this year and the way the Chancellor's brought in new rules which aren't helpful for that. But then there is some stuff that's sitting behind that. Hopefully in time, things will be able to be changed and improved. But yeah, it's still a difficult time, isn't it? I was reading something the other day to say, are we the unluckiest generation? And I was thinking, well, we haven't had any major wars to deal with ourselves. But still, it has seemed like we've had Brexit, we've had COVID, haven't we? We've had, loads of things off the back of that, various wars that have caused problems, and, people in charge of countries causing mayhem. There's been quite a lot of uncertainty, hasn't there, over the last 10 years?
Well, Ellie, it's been great to catch up as usual. I think my sort of parting advice to our listeners today would be focus on the basics, focus on buying well and adding value. I think that, provide a good service to your tenants, get tenants that stay and pay. There's far more value in that and keeping your occupancy high than there is trying to push the rents to the absolute maximum, sitting on empty rooms, chasing interest rates. Stick to the basics. I think things are looking better at the minute. They are looking a bit more predictable, but I certainly don't think it's a time to be cavalier or set any expectations that are too high in terms of where anything could go at the minute, because if the last few years have taught us anything at all, it is really not to kind of hang your hat on anything. You still don't know.
Yeah, I think it's really sensible. And I think with things like, if you're doing builds, think about sensible builds. You say about keeping good quality tenants in there. I think the other thing to think about is keeping your room sizes big. Don't try and squeeze in 8 tenants when actually it should be a 6-bed HMO. Having small rooms means a much higher turnover with tenants. But also it means you go through the planning process. There's extra stress involved. There's probably a bigger build cost. Trying to keep things simple and replicating it and having 3 or 4 HMOs in your portfolio rather than 1 or 2 is going to get you a better cash flow.
Absolutely. Ellie, thanks again. For anyone listening today, if you have got a refinance coming up, if you are buying something and don't quite know what you should be looking at in terms of mortgages and the lending options out there, Ellie is our expert. So just head over to the hmoroadmap.co.uk. You'll see a page for services and mortgages and finance, and you can drop an inquiry with Ellie and she'll get straight back to you. Ellie is incredibly helpful on so many occasions. Also, Ellie, you're able to sort of give a bit of a steer and values and share your honest and impartial advice. When people are setting those expectations and then values and trying to line that up with the right products, I know that you help a lot of our clients try and put that together with the right products as well. So
yeah, just making sure the whole thing fits together. Yeah, absolutely.
Well, I guess, Ellie, that means you and I will convene in June and we'll see where
our predictions were correct.
we'll see where they are. Thanks, Ellie.
Thank you, Andy.